It's time for Yahoo Finance's Market Minute. Stocks are rising. The Nasdaq leading gains as investors anticipate Nvidia's earnings. Super microcomputer shares soaring after submitting its delayed regulatory filings, meeting the Nasdaq's deadline to avoid delisting. Server makers' updated filings showed sales more than doubled in 2024 to nearly $15 billion. Home improvement retailers are looking to make a comeback. Lowe shares ticking higher after reporting positive same-store sales growth for the first time in 2 years, boosted by a strong holiday season and increased building following hurricanes last fall. And General Motors shares are surging as the automaker looks to reward its shareholders. GM boosting its dividend to 15 cents a share and initiating a $6 billion share buyback program. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Check-In, we break down what to expect in Nvidia's earnings, whether you should buy the dip on Bitcoin, and why investors should trade on math, not emotions. Plus, TJX is out with quarterly results this morning, and a number of retailers are set to report next week as well. We discuss some retail stock picks to consider for your portfolio, plus getting retirement ready. All week long, we've been taking a look at how to invest for retirement at every single age, from workers in their 20s, maxing out that 401k match, to those over 70 living off of their investments. And today we focus on your early 60s, what that pre-retirement age and push that one expert says is actually still a great time to keep saving. All that and much more coming up during today's show. But first, let's begin as we always do, taking a look at some of the market action. We are 90 minutes into the trading day. Stocks right now, for the U.S. major averages, we're seeing gains across the board. The Dow up fractionally 0.5%, S&P 500 0.8% higher, and the Nasdaq up 1.2%. So rising today ahead of that big Nvidia earnings report due out after the close. The S&P 500 on track for its best gain in 5 sessions. Joining me now, we've got Vance Howard, who's the Howard Capital Management CEO and CIO. Vance, you say that investors should be trading on math right now and not emotion. Explain what you mean by that and how you're looking at the state of the market right now.
Well, you know, our proprietary indicator, the HCM byline, is an intermediate to longer term trend indicator, and you need to follow the trend. It's equally as important as the Fed, what the Fed does. And the HCM byline is positive, so we see that as any pullback as being viable. And I think there's a lot of great opportunities that have set up, and you look at, Salesforce and some other areas, especially tech. So I think we're going to see the market start to bottom out, sometime this week, and I think that's a very, very positive sign. But net, we're very bullish for 2025.
Now, when you say trading on investments and trading on, math, not emotion here, no animal spirits playing in and showing up in that. How can one go about aptly making sure that they're not being overly emotional in that investment decision?
Well, I get calls all the time. I got a call the other day, and they were talking about, hey, should I sell my stocks because of what's going on? The market's pulled back 3 days in a row. And I'm like, 3 days in a row? That's a non-event. That's just movement. But the trend's clearly one thing that people need to pay the most attention to. And if the trend's up, just stick with the trade until the trend breaks. And right now, the trend's very, very positive. It's strong. And these pullbacks are actually gifts, I think. I think 2025 is going to be a wonderful year. You're seeing Salesforce pullback, Amazon pullback. These are viable opportunities for investors.
And it certainly could play out wonderful trough to peak, at least, as long as we hit some of those targets that many of the big firms have set forth. It seems like the consensus is somewhere around S&P 500, 6,600 by year end. And so we have a ways to go until we get to that point.
Right.
But one of the major bellwethers that we've seen time after time again, earnings period after earnings period, has been Nvidia.
Yes.
How much of that is a make or break, at least in the early innings of 2025?
I think what it's going to do today is somewhat stabilize the market. I don't think you're going to see the market really shoot up higher. You've got two different things. You've got the Russell 2000 and you've got the Mag 7 are now oversold. And now they were overbought, a week and a half ago. So now you're sort of working off a little bit of that trough. One of the key areas that we've been looking at also is look at the QQQ. If it can get above that 540, that's a breakout. Now it's trading in that that range, and always remember, never short a dull market. Up until the last 3 days, the past 6 to 8 weeks, it's been pretty dull. It's been just sort of sideways trading in a range. So I think there's opportunity here. Keep your emotions in check. Don't sell out just because you had 3 bad days, because 3 bad days, a week from now, they can make up for it in a heartbeat.
What we've seen in the last few sessions here as well is pressure on some of the riskier areas of the markets. And crypto naturally comes to mind with that. How have you been evaluating it?
Well, you look at crypto as 110, and it's packed off to about 87 now, 87,000 now. I think it's going to go down to about 81 to 80. I think you've got support there. I think the overall market, NASDAQ tech, is very much viable. I'd be a little bit patient on crypto. Net, now listen to what I'm going to say. I think we're going to hit an all-time high in Bitcoin by the end of the year. I think we'll come out of this 110 and shoot back up. And even the drawdown that we're seeing now is less violent and less volatile than what we've seen historically. So it's starting to stabilize.
Any price target for that all-time high for crypto?
Don't have an all-time high. I'm just predicting it'll break out of that 110. I think people will be very, very pleased. And this at 80, even if they bought it today and it pulls back a little bit further, I think you've come in at a good entry price.
I want to end the conversation where we began, and that was some of the picks that you had. And you had mentioned Salesforce, I believe, within that here. Why is that? And is that perhaps indicative of a broadening in the AI trade?
I think so. And one thing that I like, and you and I have talked about this before on your show, is I love recurring revenue. Salesforce CRM's a symbol. They have recurring revenue. They don't have to go out and resell the product every month. They get a check every month for somebody that's using it. Plus, you've got AI that can be infused into Salesforce, which can actually make a real big impact and make the product more valuable and more usable for investors and for people who are using it to advance their businesses.
Really interesting. Vance, great to have you back here in studio with us. Really appreciate the time and the insights here.
Thank you so much.
Absolutely. Now time for some of today's trending tickers that we're tracking for you. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's talk about TJX, rising after topping estimates in the fourth quarter. Comp sales rising 5% from the prior year, beating estimates there. The retailer seeing strong sales in each of its divisions, including TJX Canada and International. The CEO, Ernie Herrmann, says that the company opened its 5,000th store last year and sees many opportunities to grow the business in the future. The upbeat results overshadowing, though, some soft guidance. We will break that down a little bit further in a moment. Next, Cava posting disappointing sales guidance. The company sees comp sales between 6 and 8% with the midpoint trailing analyst estimates. Adjusted EBITDA guidance for the full year fell short of expectations. Analysts mostly bullish after the results here. TD Cowen pleased with the fourth quarter sales strength. William Blair highlighting the 5th straight quarter of increasing foot traffic. And Barclays says that momentum has sustained contrary to the industry. And finally here, we got to check in on Lowe's. That is rising after topping fourth quarter expectations, with some of the same store sales rising for the first time in about 2 years. High single-digit sales growth in its pro business and online segments, plus strong holiday performance and rebuilding efforts, as they call it, in the wake of recent hurricanes also boosted the overall sales. Still, the home improvement retailer's outlook came up a little short as it faces near-term uncertainty. This echoes similar sentiment that we heard from rival Home Depot. Well, Lowe's acknowledging the home improvement market remains challenging in the company's fourth quarter earnings call. Home Depot reaffirming that outlook, acknowledging ongoing pressure on large remodeling projects, attributing soft home improvement demand to macro uncertainty and higher interest rate environments. Here to discuss how the industry will look moving forward into 2025, we've got Bill Darcy, who is the global president and CEO of the National Kitchen and Bath Association here. Just want to get your read through some of the earnings reports for the biggest home improvement retailers here in the U.S.
Yeah, great. Thank you for having me on and representing our 55,000 NKBA members. We're here in Las Vegas at Design and Construction Week. So it's interesting that timing that, talking with you, because there's so much energy here. And I think what you're hearing from the big box retailers is the macroeconomics, what we're expecting this year, about 0.8% growth. So that's really because DIY, multifamilies, DIY mostly is bringing the market down a little bit. If you look at single family, mid to high income, though, we're looking at 4% growth. So I think that's probably indicative of some of the enthusiasm we're seeing here at Cava in Las Vegas.
And so all of that in mind, how are you thinking about the renovation market, especially for some of those DIYers, as we know that consumers right now, they're pressed for which projects they can prioritize and the costs associated?
Yeah, obviously we have our skilled labor challenges and some consumer uncertainty, and that's been the stagnation we've seen. I think we do see optimism this year and people coming off the sidelines where they're getting a little more comfortable with those, the mortgage rates as well. But really remodeling is still the driver. I think people want to stay in their homes. They want to invest in their homes. And even if they can't purchase a new home or move, this is where they're going to spend the money. So I do think, on the lower end of the market where the DIYers start in the big box stores, potentially going to see still more hesitancy because of the instability in the market. But definitely at the luxury side and the single family higher income side, we're definitely seeing a lot of growth potential.
I wonder what you're hearing from the pro side of these businesses, the contractors, those who are working on construction and trying to make sure that they are sourcing correctly to meet the demand that they're seeing as well.
Yeah, interesting. We have like over 2,000 brands here at KBIS and Design and Construction Week with the International Builder Show as well. And I think that's what they're desiring, sourcing products. Where can they be creative? We have an interesting membership because it's their creativity. I mean, these folks are making beautiful spaces. So they're very resilient, they're very creative, and they work around challenges. And I think they love to source new products. So yes, you will see some shifts in there. I think, the consumers want to maximize their budget with the best products they have and the more intelligence that the pro will have and knowing the best products and services that are available to the consumer, I think makes them more valuable, and trying to get these projects done within budget.
To the extent that it's making its way through the conversations at the conference, how is and what is the pulse check on tariffs and the impact on some of these larger projects?
Yeah, it's interesting because coming into the event, certainly this seems to be topical, the biggest top of mind. And I was a little concerned, like, what are we going to say? We have to really, it's too early to tell. I mean, that's the truth of it. However, you would never know that on the show floor. The optimism is so strong. And I do think people believe these things will settle down. I think this is disruptive. I mean, we have immigration tied in and all this, things that it's hard to understand even for the average contractor consumer. But it's surprisingly mild or non-existent, I would say.
All right. Well, if you see a stress ball tchotchke on the floor, make sure you send one my way, Bill. Just lastly, while we have you here.
Absolutely. Yes.
Lastly, while we have you here, as we are thinking about the broader mortgage rate environment and how that impacts everything that we've been talking about, to the potential for new home build outs, for the potential for remodeling projects as well, as many are spending further in as they're not going to be, for some of them, moving anytime soon, especially if they're sitting on a good mortgage rate and don't feel like they need to refinance at all. How closely are you tracking what's taking place within the mortgage rate dynamic as it passes through to some of the biggest contractors and suppliers?
We were, the magic number we felt was 5%. Many of the mortgages, in the market are well below 5%. And then that's really what's sometimes driving that remodeling versus moving. I mean, no one's going to move from a 2% mortgage to a plus 5%. But I think we feel consumers are getting a little more comfortable with that 5% and not going to stay on the sidelines forever. But we are tracking this very closely. I'm actually going to, we're going to see what the Fed's going to do. And I don't know that they're going to be very aggressive, is what we're feeling this year. But despite that, I think as the consumers feel more and more comfortable with 5% and really their desire to really stay in their homes, this really does drive remodeling. So yes, we feel for the construction side and the new construction side and new home side, but we really feel that that even higher interest rate sometimes is the driver for further remodeling.
Bill, thanks so much for taking the time here.
My pleasure.
I'll be looking out for that stress ball.
Absolutely. See you soon. Thanks again.
Coming up, everyone, why investors are increasingly drawn to alternative assets. That is next on Wealth. A report from Preqin estimates that by 2028, the total alternative assets under management could grow to over $24 billion. That's up from $16 trillion. Let's talk about this again. $24 trillion, up from just $16 trillion 2 years ago. Joining me now in studio to break down why alternatives are growing in popularity is Dave Donahoo, who is the Franklin Templeton head of U.S. Wealth Management Alternatives. Dave, great to speak with you here. Let's just break down that figure in itself here. $24 trillion is what we're talking about. It could potentially grow to. What is going to be the leading driver of that?
Yeah, it's a great question, Brad. And first off, terrific to be with you today. 3 big drivers are moving this forward, right? It's really a sun, moon, and stars aligned scenario. On one side, the investment case for alternatives has never been stronger, and that's paired with technology innovation and really what I view as a product manufacturing revolution. So let's break that down. On the investment side, Take public stocks for an example. If you look back 20 years, we have roughly half the companies in the US publicly traded that we did 2 decades ago. Another way to view that, companies in the US that generate over $100 million in revenue, somewhere between 10 to 15% of them are publicly traded. So people are realizing if you're not investing in alternatives, which may no longer be an alternative, you're missing out on the growth of the economy and the full opportunity set. That trend holds in real estate, and it holds in private credit as well. So that's the demand side that is moving, in particular, individual investors to the alternative market. That demand is spurring innovation to satisfy demand, from technology, making access easier and broader, and from manufacturers creating new product that's created for the wealth space, making it easier for them to adopt these types of solutions.
We were talking in the break about all the new different types of alternative assets that have emerged here. What asset classes, though, are you seeing the most interest from those who are looking to add this into their portfolio?
2 areas really stand out to us. One is in private equity, a subset of it called secondary private equity. That's where you invest into a primary private equity fund, taking someone else's position in that exposure, often at a discount. And we're seeing growth there in wealth in particular, because it allows folks who historically haven't had exposure to get that exposure quicker in a high quality and diversified way. The other area, which may be a bit controversial, is real estate.
Interesting. Why is that controversial at this point?
Well, I think people read the headlines and they see what's going on, notably in office. And we have had on the equity side of real estate a period of the last couple of years of corrections. But if you look at certain parts of the equity real estate market, namely multifamily apartments or industrial, think data centers, think warehouses for e-commerce, the fundamentals are really strong. And because pricing has come down over 2 years, you're seeing a ton of interest. But interestingly, Brad, on the debt side of real estate, that's where we see probably the longest runway of growth for the next decade. It's following a path that private credit followed post the global financial crisis. And history doesn't always match identically, but it often rhymes.
Certainly.
And we see real estate debt about to go through a super cycle of growth, like you're seeing private credit experience over the last decade.
If you are adding alternative assets to your portfolio, what should your ideal time horizon look like? And I know this is going to be different based on the type of asset that you're adding in.
It's a great question, because this is what scares folks off if they don't fully understand that. They think alternatives are inherently illiquid and they're locked up forever. The first thing I would say is it's important to understand your unique situation. What's right for you? Work with an advisor or work with a trusted partner. Generally speaking, you're not going to allocate a majority of your portfolio to alternatives. Institutions, for instance, average about 30%. The wealth investor is somewhere closer to 3% today. So that number needs to come up, and it will come up. But we don't know that it ever gets to the 30% institutions have. The way I would think about it is in a 5, 10, or 20% of your portfolio, allocating to things like private equity, private real estate, private credit can enhance returns, increase diversification, help with yield or tax efficiency, depending on the asset class. But you want to be mindful that that pool of capital isn't something you're going to touch every day. In fact, I saw one of your earlier segments and you said, follow the math, don't follow the emotions.
Yeah.
Private markets allow you to follow the math because they price off fundamentals with less frequency, but they aren't going to have the same volatility of the public markets that are moving based on market sentiment.
We got about 30 seconds left here. As we're trying to make sure that the maths, if you will, what should be the kind of general rule of thumb? And again, different across asset types, but the type of returns you should be looking for in these emerging asset classes or alternative assets?
It's going to vary by asset class, to your point. But generally speaking, there's a long studied concept of an illiquidity premium, both academically and in kind of real life. Right. And that illiquidity premium says if you take a portion of your money and you're willing to lock it up and be patient with it for a longer period of time, you can, in private equity, potentially increase your returns, in private credit, potentially increase your income. And it's important to understand how these pair with your total portfolio, right? So it's not a standalone decision, but how do I integrate the right way?
Dave, great to see you here in studio. Thanks so much for joining us.
Thanks for having me, Brad.
Absolutely. Coming up, everyone, what retail stocks should you add to your portfolio and which should you avoid? I talked to a retail strategist and analyst about that next on Wealth. TJX full year same store sales growth forecast came in weaker than expected, making it the latest retailer along with Walmart and Home Depot to express caution in its forecast for the year ahead. Retail earnings roll on next week too. We'll get results from the likes of Target, Abercrombie & Fitch, Foot Locker as well, and more. Here to discuss is Stacy Widlitz, SW Retail Advisors President. Stacy, great to have you here with us. So first, want to get your reaction to TJX's earnings this morning.
Very strong mid-single digit comp numbers here. And really what you need to focus on is transactions are up. This is not a ticket story. This is a traffic story. This is a story where the consumer is getting, hit every way with inflation, yet incredible treasure hunt and value, one of our very long-term top picks, and continue to like the stock here. Yes, like Walmart, TJX was a little bit conservative on their guidance. I mean, this is quite normal for Walmart and TJX to approach a new year conservatively, particularly since there's so many moving parts in our economy right now, and with the administration, with tariffs and what ifs. So I think it's more about just being conservative than actually what's going on right now. Walmart has said their consumer is very steady right now.
And so those are some of the themes that could certainly kind of transpire through some of the other big names in retail. I want to run through some of your takes on some of those big names. Abercrombie & Fitch, for instance, that's off to a rough start this year after rising nearly 70% in 2024. How are you evaluating the growth and how that translates into the share price appreciation from here?
Yes, we've seen a group of brands come out on the other side of COVID and really keep full price selling intact. And investors have looked at this group of stocks, Ralph Lauren, Tapestry, Abercrombie, and said, is it sustainable, or are they going to go back to discounting someday? Tapestry and Ralph Lauren have shown us, yes, overwhelmingly, this is sustainable. Both of them had double-digit average selling prices up last quarter, and the consumer was out there buying. Abercrombie, that's reporting next week, they've shown a couple promotions on the Abercrombie brand in the last couple months. So that's a big question mark here. And the stock has traded off significantly because we've seen some of those promotions hit the market that would suggest maybe their full price selling is not as intact as other brands.
Next here, as we're talking about some of the brands, let's talk about Nike. Big turnaround plan underway here, new CEO at the helm. So how are you looking through this brand and your assessment there?
Yeah, I think, Nike, first of all, has a ton of newness in the market right now in footwear, which is great. But I think also, Nike has cut back. They have kind of alienated some of their core runners. They're trying to get that back. It's a big ship, and it's going to be a big task to turn it. You've seen on running, you've seen Hoka take nice share from Nike, and they may be able to get it back, but I think right now I'm still conservative on the stock. We've been negative on the stock for close to a year and a half, and I would say that there's still some flags in the market. The percentage of apparel on discount is up year over year. Footwear is like, there are green shoots in footwear, absolutely, but I'm still a wait and see on that one.
You mentioned Hoka. Let's talk about their parent company, Deckers here. So how is the market share gains there sustainable in terms of the growth that we've seen come forward for the brand?
I think it is. You've got the Uggs brand, obviously, which has accelerated over the past year and has been performing incredibly well. And of course, you have Hoka, which has been growing heavy double digits for years. And investors have been looking at the stock saying, again, when is it going to slow down? Can this last? And yes, their numbers did decelerate a bit this quarter, and their guide was somewhat conservative, but they have new launches in the market that are being received incredibly well. And I think that brand absolutely has staying power and will continue to grow here and will continue to take share. So, the stock has come down nicely on some very conservative guidance. So I would take a look absolutely at that stock. You've got two incredibly powerful brands that continue to perform and continue to launch new drops that are being received very well.
Well, let's talk about a company that hopes all of the newness is positive, and that's Foot Locker. They report earnings next Wednesday. Is this a stock you like?
No, again, we're avoiding Foot Locker. And if you think about it, Foot Locker is over 60% exposed to Nike. So if you want to play Nike, play Nike. Foot Locker is obviously the middleman. And again, they've had a lot of apparel on discount. It's been up year over year. They are benefiting a little bit this month from some of the new drops, which is great. But I think there are better places to look for investing at this point.
Lastly here, while we have you, we got to talk about the name that is within a 10-mile radius of 90% of America, and that's Walmart. Their latest guidance came in a bit conservative. Do you see headwinds ahead for the company, especially as they have several different aisles and categories that they're trying to maintain across for consumers' mindshare?
You know, Walmart's numbers were very strong. They did a 4 comp on top of over a 4 comp last year. The traffic is still positive and the ticket is positive. And if you think about this environment, again, inflation, it's not transitory, it's not going away. It's actually reaccelerating a bit in food. If you think about it, they are the best positioned in the market to go back to their vendors and say, you know, give us a break. We want to pass it on to the customer. We're not raising prices. And they win at that. You know, also don't forget they were positive in every category, even general merchandise, even though there was some deflation there. And of course, they have all these other higher operating margin revenue streams like advertising and marketplace that are just getting started. And finally, they are not the old Walmart. They are the new Walmart, where the higher income consumer is the majority of their comp growth, because those customers are now looking for value, whether it's food or health and wellness, and they are gaining that share. And I think that is not going to change anytime soon. So I'm a huge fan of Walmart here. Yeah,
Walmart CFO John David Rainey has joined us on the program before, talking about those higher end consumers trading in to Walmart. Stacey, thanks so much for your evaluation, this roundup of retail that we've been able to run through. Appreciate it. Nvidia is reporting fourth quarter results after the bell today. It's been the hottest stock on Wall Street for years now, up over 450% in 2 years. But as of Tuesday's close, the stock is trading 17% below its 52-week high. It's actually down so far in 2025. So, how are financial advisors talking to their clients about Wall Street's AI darling? I think I'm going to go check in with Decoding Retirement host Bob Powell and see how he's talking about this one. I heard he's in the building. Let's go see him. How are financial advisors talking to their clients about Nvidia right now?
So they're talking to them in two ways. One is to say, don't bet the ranch on an individual stock, even though it's a darling. Think about diversification. So for instance, you already own maybe a S&P 500 ETF, which has a 6% allocation to the S&P 500. So you already own Nvidia, right? And so if you think about it, the tenets of prudent asset management would be to say, you need to be diversified, right? And by owning an individual stock, what you're doing is creating unsystematic risk in your portfolio.
So what place does Nvidia have in your portfolio then?
Well, I think I would take a step back and think, what place does it have? And the first thing I would say is, what are you trying to accomplish with it? So if you're saving for retirement, you have a long-term time horizon. And perhaps, again, as I mentioned, you already own some of it. And if what you want to do is to take a portion of the money that you can afford to lose, mad money, maybe put a 1 or 2% into Nvidia as a long-term bet. Likewise, if you're in retirement, I like to think about it in two ways, Brad. One is you want a floor of income that will fund your desired standard of living, your essential expenses, and then you need upside for 20 or 30 years to protect yourself against the risk of inflation. And in that case, Nvidia might make sense as a long-term bet to help you the upside portion of your portfolio. Okay. I say all this with two things in mind. One is think about the risk that you're bearing for the return that you're getting. So go to Yahoo Finance. They have a number of tools that you can use to assess what's the risk-adjusted return of Nvidia, and that's really the key thing that you want to think about. And the other is risk tolerance, or I like to say, think more about risk capacity, which is how much money can you afford to lose, and what's the dollar amount, or what's the percentage decline that you can afford to lose. And so when you're thinking about investing in Nvidia, whether you're planning for or living in retirement, think about that.
When you talk about unsystematic risk, what do investors need to know about that risk that surrounds any name, but especially a name that is as popular and as long a trade as Nvidia?
Yeah, I mean, when I think about unsystematic risk, it's risk that you can't diversify away, right? It's unto itself with that company. So it's going to go up and down depending on the fortunes of that company. And the thing about Nvidia is, if you lived through the 60s, you witness things like Polaroid and Xerox, which were darlings and are no longer. Or even more recently, you witness darlings like Intel, and maybe not so much anymore given the allure of Nvidia. So I think you need to think about it pragmatically and to say, look, it may have its time in the sun, but I need to sort of protect myself. After all, what is it that you're trying to do, right? You're trying to build wealth in order to fund a lifestyle. And at some point, you can't put that lifestyle at risk.
And so when you think about names that have been as popular as Nvidia in the past in the stock market, and what that has done for people's planning, how many of them say, okay, I need to have this as a component within my retirement portfolio, but it can't be all of it. Where else is that diversification happening?
Well, I think it comes in a couple ways. One is to have, broad exposure to the markets. Maybe it's the S&P 500. Maybe it's a mid-cap index. Maybe it's a small-cap index. Maybe it's a growth index or a value index. And then maybe it's by sector. So maybe you're in the defense sector or the consumer goods sector or things like that, right? You need to sort of think about it as how a prudent portfolio manager would manage their portfolio for the benefit of, the people that they manage the money for. You are you're not a gambler, right? You're not a speculator. So what you're trying to do is just be thoughtful about how you manage your money, and you don't want to take risks that you can't afford to take.
Are there key things that those who are saving for retirement should listen for in earnings calls like that from Nvidia that give them a sense of how the company is bearing up to what their timeline to retirement looks like?
Yeah, I think that's a great question. Again, I would go back to Yahoo Finance's investors tools and sort of, do the basic analysis that a fundamental analysis would do if you were a portfolio manager at Fidelity or Vanguard or T. Rowe Price or Schwab. You would be looking at their earnings relative to the past. You'd be looking at their future earnings. You'd be looking at their earnings relative to their competitors. And you'd be getting a sense of what's the long-term prospect for me to make money in this particular stock.
Absolutely. Bob, thanks so much for breaking this down. We're going to be watching closely to see how the market reacts to these earnings and how those saving for retirement or in retirement are able to really glean some insights about this name, which has certainly been a bellwether for the stock market. Appreciate the time, Bob.
Thank you, Brad.
House Republicans passing a budget bill backed by President Trump that calls for $4.5 trillion in tax breaks and $2 trillion in spending cuts. But critics are concerned the plan could put Medicaid at risk. Yahoo Finance's Jordan Weissman is here now with more on what the bill means for health care. Jordan, what do we know?
So the key thing to know about this bill is that it does not say outright that Republicans are going to cut Medicaid. And that's something Republicans have been emphasizing. It does not say, oh, these are the specific cuts. Instead, what it does is it calls for at least $880 billion worth of cuts over 10 years from the committee that oversees Medicaid, right? So it's basically saying that as they go through this legislative process to pass Trump's agenda, they're expecting a lot of these savings to come from Medicaid. They're just not saying exactly what they're doing yet. And if you do see those kinds of cuts, I think most experts are accurately predicting, pretty much devastation for a lot of state Medicaid programs.
And so with that in mind, what is the total potential impact of this? And you mentioned that it's over a certain period of time. I believe you said 10 years. And so all that considered, how much time would people who are affected by this have to change their plans or figure out a new plan even?
I mean, it could be pretty instant. We don't know the exact cuts they're thinking about, but some of the ideas that are being batted around are things like adding a nationwide work requirement onto Medicaid, which tends to knock people out of the program just based on paperwork. We saw this happen when Arkansas experimented with it. A lot of people just didn't know about the work requirements and ended up losing coverage, even though they might have qualified. Another idea they have is lowering the amount that the federal government pays states for Medicaid, right? The federal share of the burden. And if they do that, what you could see is the Obamacare Medicaid expansion sort of begin to collapse. A lot of states expanded Medicaid on the condition that the federal share of funding stayed at a certain level. I believe 10 states have a trigger law that would automatically roll back their program if the federal matching funds were cut. And if that were to happen, you would see millions upon millions of people pretty much instantly significantly lose their coverage. So you're talking about fast and significant impacts on a good chunk of the American population.
Jordan, thanks so much for digging into this and the details as well. Really appreciate it.
Thanks for having me.
All week on Wealth, we're covering how to save for retirement at every age across all generations, and we've finally reached the baby boomers. According to BlackRock's Read on Retirement report, 68% of baby boomers feel ready for retirement. Around half aren't sure how much they'll be spending in retirement or how to calculate how much they need. Here to break down what those early 60s savers need to know, we've got Sarah Brenner, who is the Ed Slott & Company Director of Retirement Education. Sarah, good to have you on the program here with us. Let's start with your 401k. What are the options for combining or rolling over those accounts?
Thank you for having me, Brad. Yeah, when somebody retires, when they leave their job in their early 60s, that's a common time when that happens, they're going to have some big decisions to make. And it's really important that they consider all of their options before doing anything. One option that we always hear about is rolling over to an IRA, and that can be a great option, but it is not for everyone. You want to think about all of the possibilities. For some people, keeping the money in the employer plan may be the way to go. If someone's concerned about creditors, employer plans, they are protected under ERISA, and that is the gold standard. IRAs outside of bankruptcy, creditor protection is only available under state law, and that can vary. So if somebody's concerned about creditor protection, staying with the plan, that may be the best choice. Another possibility that many people may not be aware of, taking a lump sum distribution. That might sound crazy, but it can make a lot of sense if you have highly appreciated employer stock in your retirement plan at work. You can take advantage of a tax break called NUA. If you're too quick with the trigger on an IRA rollover, you're going to lose that tax break.
You call the 60s.
For a lot of people, the IRA rollover, that's the way to go. There's a reason why this choice is popular. IRAs are great for access. It's easy to get at your money in an IRA. IRAs offer a world of investment options. Your possibilities for investment choices are almost limitless. In addition, IRAs, they're easy to work with when it comes to estate planning or taking required minimum distributions.
Certainly. And so with those options, you call the 60s a sweet spot for withdrawals. Why is that?
Yeah, we like to call the 60s the retirement account sweet spot. The reason for this is that you no longer need to be worried about early distribution penalties. If you tap your retirement account before age 59 and a half, you are likely to get hit with a 10% penalty. And that's on top of any taxes that you would owe on the distribution. There are some exceptions to the 10% penalty, but those exceptions, those are hard to fit into. So most people under 59 and a half, you tap your retirement account, you're looking at a penalty. After 59 and a half, that goes away. When you reach age 73, you need to take required minimum distributions from your retirement account. In your 60s, you're in the sweet spot. You can tap your money without concern about early distribution penalties, and you're not forced to take money out yet. No RMDs until age 73. So it really is the sweet spot for planning. You have a lot of flexibility. You can take money out of your retirement account on your schedule and not the government's.
Certainly. So if people want to save more in their 60s, what can they do?
A great option is continuing to contribute to your employer plan. If you're still working, the Secure 2.0 Act has created super catch-up contributions. If you're age 50 or over, you can contribute more to your employer plan. But for those who are ages 60, 61, 62, and 63, there's an even higher catch-up limit, and we call these super catch-up contributions. For 2025, rather than being limited to $7,500 as a catch-up contribution, you can put away $11,250. Now, once you reach age 64, that goes away. Those super catch-up contributions, they are targeted, they're limited to people in their early 60s.
Sarah, thanks so much for taking the time here with us today. Really appreciate you breaking this down for us.
Thanks for having me.
Coming up, we'll dive into the impact of diversity, equity, inclusion initiative rollbacks on small businesses and content creators next on Wealth. In the wake of President Donald Trump's campaign against diversity, equity, and inclusion programs, or DEI, we've seen companies roll back their own initiatives. Walmart, Target, Lowe's, Amazon are just a few of the major corporations we've seen reduce or eliminate programs in recent months. Now, consumers plan to speak up with their wallets, with many social media accounts planning a spending blackout on February 28th in protest of these anti-DEI moves, instead asking others to spend at small businesses if they can. Joining me now, we've got Marcus Collins, who is a marketing professor at the Ross School of Business at the University of Michigan. Marcus, always a pleasure to grab some of your time. Want to get your take here and input on what we're seeing play out and how consumers are being vocal, planning to be vocal with their spending, and for some of them with the shares that they hold too, because a lot of these programs have been put to shareholder votes.
Oh, well, it's always a pleasure to be with you, Brad. And I think what we're seeing here is how social change happens. When we think back to the civil rights movement, we think that, at least the way it's mythologized, is that there was an appeal to people's goodwill, to their altruism, that made them change their mind and how they operated against people of color. Well, the truth of the matter is that they attacked their pocketbooks. And this is exactly what we're seeing happen today. I mean, according to the Harris poll, 40% of Americans have decided to shift their spending towards companies that are more aligned with their ideology. The Guardian even sourced that 25% of Americans are moving their spending from brands that they love to brands that are more inclined to be aligned with their ideology. This is about ideological congruence, and it only makes change when it actually has a consequence. And in this country that's based in capitalism, that consequence has to be through commerce.
You know, I was speaking with John Hope Bryant, the founder, CEO of Operation Hope, and he was mentioning that the way for consumers to also go about this is not just to boycott Target, but also go buy up all the inventory of the Black-owned businesses, the entrepreneurs that have sold into some of these mega retailers, and then take it one step further and go purchase specifically from them on their websites as well, so that the shelves are being cleared of their products, and then you're also continuing to support the business. In that congruence that you're talking about for consumers here, how much is this also playing out in trends now that businesses have more avenues, more channels to sell their products and their services?
Yeah, this is about empowering agency. The fact that I can sell directly to a consumer, it obfuscates my dependence on a retailer being the primary way in which my product reaches people. There's different distribution outlets. And I think that actually there's a symbolic gesture that happens there too when I buy only Black products or from brands that are aligned with my ideology.